If your business needs equipment to grow, machinery, vehicles, technology, tools, this video walks you through every way to finance it and what each option actually looks like in the real world. Let's start with the core idea. Equipment finance lets you get the asset now, start using it to generate revenue, and pay for it over time. You're not draining your cash reserves to buy something up front. The equipment pays for itself while you own it. There are three main ways this works in Australia. The first is an equipment loan. You borrow the money, buy the equipment, own it from day one, and pay the loan back over an agreed term. The equipment itself usually acts as security. A construction company in Queensland used this to finance $200,000 worth of excavation equipment. The machines were on site generating revenue from the first week. They paid the loan down over 5 years while the equipment did the work. The second is a finance lease. The lender buys the equipment and leases it to you. You make regular payments over the lease term, and at the end, you typically have the option to buy it outright, extend the lease, or hand it back. A Melbourne printing company took this route on a high-end digital printer. It increased their production capacity by 50%, cut their operational costs by 30%, and grew their revenue by 40% in the first year alone. The lease structure meant they kept their cash free for everything else. The third is an operating lease. Shorter term, lower payments, and at the end, you hand the equipment back. This works well for technology or anything that dates quickly. A Perth software company leased a high performance computing cluster this way. It let them offer cloud based services and compete with firms 10 times their size without committing to owning hardware that would need replacing in a few years anyway. Now, a few things worth knowing when you're comparing options. Tax treatment matters. Lease payments are often fully tax deductible. Equipment loans may allow you to claim depreciation. Talk to your accountant before you decide. The structure of the deal can change what you actually pay after tax. Look at the total cost, not just the monthly payment. A lower repayment over a longer term can cost you significantly more overall. Run the full numbers and read the end of term conditions carefully, especially on leases. What are your options? Are there penalties for early exit? What happens if the equipment is damaged? These details matter, and reputable lenders will explain them clearly. When you're ready to apply, you'll generally need your financial statements, bank statements, a clear description of the equipment you're financing, and sometimes a quote from the supplier. The stronger your business financials, the better the terms you'll be offered. The full breakdown of every option, including how to assess what's right for your business, is in the article below this video.